And the end of term numbers for most companies is astronomically high. So they do it on purpose so that they can get you into a whole life or permanent policy. Does that make sense, Tiffany? Awesome. Okay, so whole life insurance. So life insurance that may be kept in force for a person's entire or whole life, which pays a benefit upon a person's death. So that's kind of the key here, right? It is sold as a policy that stays in force for the person's entire life, right? Until they pass away, or until they turn 100 in most cases. Now, part of the premium payment will go into a cash value or an investment. Another part of the death benefit and other parts for expenses, things like commissions and administrative costs. So you got to look at the premium they're paying, right? In term, the premium is pure protection. You're paying for the protection, of course, a portion of it, in our company's case, $75 a year for the actual fees and administrative costs. Right, but the bulk of it is towards the cost of insurance, right, or the death benefit rather. Okay. The challenge in a whole life, you really have no control over how the money is invested in the policy, right? Because there is no delineation, or there is no it doesn't specify what percentage goes into a whole life policy. So when you pay a premium, let's say $100 a month, we don't know what portion of that 100, let's say your cost of insurance is $30, we don't know what portion of the 70 is actually being invested. It doesn't have to share it. It doesn't have to show it. So you have no control over how that money is invested. That's generally speaking how the whole life product works. Now, universal life product is policies which pay a premium, which the premiums and coverage is adjustable. It changes, it moves. Now, for people, that is almost good, right? People look at it because you normally have 3 different payments. You have what's called the minimum premium, the target premium, and the planned premium. By the way, universal life is also known as flexible premium adjustable life. So the payment and the death benefit change. That is never a good thing when you're talking about something that's supposed to be pure protection. Now, the way these are set up typically is the first 2, the minimum and target premium, are a very expensive, term policies, short-term policies. In most cases, the minimum premium, the payment you're making, is a 5 to 10 year level term. The target premium is typically 10 to 20 years at a very high cost. It's not until if you're not paying the planned premium, that one is the one that allows you to start building cash value, where the savings start to occur. So they sell it as it has extra options as compared to whole life, but it comes with a high surrender charges. What's the surrender charge? It is the cost that, or the penalty rather put, assessed if you were to stop the policy within a period of time, typically 10 to 15 years. But I've seen policies go up to 20 years. Where you have a penalty for stopping the policy. So if you have cash value in there, for example, $5,000, there's a surrender charge of $6,000. So essentially you have none built, nothing built. That makes sense? By the way, the universal life product was designed or created in the early 1980s by the insurance industry to combat against the buy term and invest the difference concept. That is their version of buy term and invest the difference. And it's worse. It's a horrible, so much worse product than the whole life. Whole life, at least you have some fixed guarantees. In universal life products, you're only guaranteed to overpay it and have no guarantee of even having a death benefit. So how is that even better? It's worse, right? A little bit more complicated to understand, but it's worse, right? Variable life is a hybrid, right? It's permanent insurance and an investment, right? The cash value is not guaranteed. The cash flow, which is not guaranteed, is invested in equities, T-bills, bonds, money market funds, right? That's kind of how they see it. The flexible premiums are said to be guaranteed, but will actually fluctuate depending on the investment. And the death benefit varies with performance and investments, with performance of the investments, right? So it's kind of a universal life policy, but very specific in how it's invested. You can actually see the investments associated with it. Now, here's what's crazy. You are required to have a Series 6 and 63 to sell this product. You're required to have it. You cannot sell this product without having a Series 6 and 63. You have to have an investment license. A couple years back, I don't know exactly, maybe 10, 15 years back, the IUL was created, Index Universal Life Policy, which agents do not need to have a Series 6 and 63. All you need to do is have your life and annuities license. Now, this combines insurance with an investment, but it mirrors the activity in a selected index fund, like the S&P or the Russell 2000. So if the index fund goes up, you get a piece of the returns. But if it goes down, you're protected. That's what it was designed to do. Part of their selling point is they'll tell the client, you have all the best parts of the returns on the investment, but you're protected on the downside. That's what is sold. How nice does that sound? It sounds like a good product. In face value, though. No pun intended. The catch is you only get a piece of the returns. What piece is that? We don't know. It's like, if I'm home, if I'm at the office working late and I know the kids, let's say on a Friday, we usually get them pizza. We have pizza in a movie or something like that. I know I got to tell Tanya to take a couple slices aside. Because if I come home, I'm only going to get a piece of maybe a piece of a slice. So that's the catch. If it goes up, they don't tell you how much of that you get, right? Get none of the dividends on the index, or the index generates, because again, it's not an investment. There's a cap on how much you can gain, right? In other words, if the market does come back and does 20%, there's a cap. They don't give you the 20%. Plus, you pay the usual fees and commissions, and in most cases, is the fees and the fees associated with universal life policies are ridiculous. Ridiculous. So these are some general fundamentals of life insurance, guys, that you need to understand, you need to know, you need to get a better handle on. Look, I believe from experience, selling term and investing the difference is, number one, the best way to sell life insurance and the simplest way to sell it. Because term is straightforward. You pay you need X amount of money. Here's what it will cost you based on your age and your health. There is no bells and whistles that you have to go through. And then you create a hypothetical, an investment plan that that ensures or helps a family ultimately be in a position where they won't need life insurance. Now, I've said that before, right? The whole goal, right? The textbook definition of life insurance is having immediate estate in the case of premature death. I'm going to show you guys something that is part of our presentation, but a lot of people probably don't realize it's there, nor understand how to even explain it if they were to have to come across it. So when we talk to families and we go over the income protection or income replacement, how we define it, this is the page, which again is the last slide on the presentation and our presentation, which represents how we replace a breadwinner. Okay, it's really, really important to understand this, and it's simple. So let's say I passed away. My family, I made $5,000 a month. It was determined that I needed $600,000 a month. Why? Because $5,000 a month times 120,000 per in coverage is $600,000 of coverage. That ensures that my family has $60,000 a year coming in if I'm not here. So if you look at this, this is a hypothetical with American funds, right? We use the fund and income fund of America, which is a growth and income fund, basically. So the question is, if my family received $600,000 check, what do most families do with that? How long would that money last? Even if you're responsible, you make the right choice, or you try to make the right choices, you might pay off the house, that's $300,000 gone, pay off a few cars, put the kids' education already in play, all that stuff, right? And the $600,000, without a mortgage, maybe kids' education funded, whatever you have left over will help here and there, right? Person still works, you've gotten rid of the mortgage. It isn't the worst situation, right? However, it stops at $600,000. Part of understanding the rules of the money game is understanding how to preserve that money, how to make it last. So I would tell a family, take that same $600,000, put it into an account or a fund that conservatively gets you, a 5-8% rate of return. And if you were to take out $60,000 a year, as if I was still making that money, so the mortgage is still paid off, right? You're still funding the education expenses. You might have paid off a car, right? If you run it through 20 years, right? From 1977 to, let's say, 2017, it's actually 30 years, right? Am I right? No, that's 20 years. 20 years, you withdrew $1.1 million. You still have a little over 100 left. That's the right thing to do. See, a lot of times when a client, I notice that they're confused, or, when I talk about replacement of income, show this slide. It's in their face. It's quantifiable. They, believe it or not, love that. When you explain it like this to a family, they love it. They get it. They see the picture now. And you all of a sudden became a hero. You became someone that has never explained it to them like this. And you now become, in their eyes, the ultimate or the consummate professional, because you can offer everything. You're now an advisor. You're not an insurance agent. You're worth more. So if there becomes a discrepancy where they have to make a decision of now getting a 20-year term with a company for, you know, or a 30-year level term with a company for, you know, $60 a month versus your 64, your $65, everything else being the same, you're gonna choose you because you're worth that difference. So it's little things like this that you need to know and understand to kind of put all the pieces together of this puzzle we call financial planning and financial independence. Does that make sense, guys? All right, so time is up. Anybody has a quick question? Yes, Tiffany King. I love your name, Queen.
Thank you. It's an expensive name.
I like that.
So going back to the policies really quickly, I like to hear